Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kenvue Inc. Annual Report. Kenvue Inc. offers a wide range of consumer health products across various segments. The company's self-care segment provides over-the-counter medications for coughs, colds, allergies, pain relief, digestive issues, smoking cessation, eye care, and more under well-known brands such as Tylenol, Motrin, Benadryl, Nicorette, and Zeotec. In addition to self-care products, Kenvue Inc. also offers skin health and beauty products through its Skin Health and Beauty segment. This includes face and body care, hair care, sun protection, and other personal care items under brands like Neutrogena, Aveeno, Dr. CI, Labo, Le Petit Marseillais, Lubriderm, Rogaine, and OGX. The company's Essential Health segment focuses on providing essential health products for oral and baby care, women's health, wound care, and other critical needs. Its brands include Listerine, Johnson's, Band-Aid, Stayfree, OB, tampons, Carefree, and Desitin diaper rash. With a presence in multiple regions worldwide, Kenvue Inc. is a leading consumer health company offering diverse products to cater to various customer needs. Unfortunately, I do not have access to the provided text. However, I can provide a general essay on what might cause a stock price to drop. The decline of a company's stock price is often a complex issue with multiple contributing factors. One possible reason for a decrease in stock value is poor financial performance. This can include decreased revenue, increased expenses, or reduced profitability. Companies that struggle to meet their financial obligations may see their stock prices plummet as investors lose confidence. Another factor that can impact a company's stock price is changes in the market environment. Economic downturns, industry disruptions, and shifts in consumer demand can all contribute to a decline in stock value. Additionally, companies that fail to adapt to these changes or are slow to respond may see their stock prices suffer as a result. Regulatory issues and scandals can also have a significant impact on a company's stock price. Companies that are found guilty of wrongdoing or are subject to costly regulatory fines may see their stock prices drop as investors lose trust in the company's leadership and operations. Finally, external factors such as global events, natural disasters, and changes in government policies can all contribute to a decline in stock value. These events can create uncertainty and volatility in the market, leading to a decrease in investor confidence and a subsequent drop in stock prices. In summary, the decline of a company's stock price is often the result of a combination of internal and external factors. Companies must be proactive in addressing financial challenges, adapting to changes in the market environment, and maintaining a strong reputation to avoid a decline in their stock value. Kenvue Inc. market capitalization of $36 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Kenvue Inc. holds a significant advantage in their industry. Kenvue Inc. trades at a higher price-to-earnings ratio of 25 times and a higher price-to-book ratio of 3.37 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.43%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. Revenue growth is evident in certain segments, such as Latin America, which saw a slight increase from $1,339 million to $1,343 million in 2024. Additionally, the Europe, Middle East, and Africa region experienced a significant increase from $3,388 million to $3,559 million in 2024. On the other hand, revenue decline is attributed to several factors. The Zantac business sales have declined, as well as OTC medications containing ranitidine and phenylephrine, PE, products. Furthermore, securities class actions pose a potential threat to investor confidence and revenue. Adverse macroeconomic developments, such as rising interest rates, also contribute to the decline in revenue. Moreover, the further deterioration of market conditions in the skin health and beauty business has had a negative impact on revenue growth. The inability to execute company strategies effectively is another significant driver of revenue decline. In conclusion, while certain regions and segments have experienced revenue growth, several factors are driving revenue decline. These include declining sales of specific products, adverse macroeconomic developments, and market conditions in the skin health and beauty business. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it increased by 42.7% from $1.03 billion to $1.47 billion due to an increase in cash flows from operating activities. However, this trend was short-lived, as the net income decreased by $440 million, or 42.6%, from 2024 to 2025. Profit margins also experienced changes during this period. The net income margin increased from 6.7% to 9.8%, while the operating income margin rose from 11.9% to 16%. However, these improvements were offset by decreases in certain segments. For instance, the self-care segment saw a decrease of $180 million, or 4.6%, and the skin health and beauty segment experienced a decline of 21.4%. The reasons behind these changes are multifaceted. While an increase in cash flows from operating activities contributed to the initial rise in net income, volume-related net sales decreases, unfavorable foreign currency exchange rates, and the impact of tariffs led to decreased profit margins. These factors highlight the complexities involved in managing a company's financial performance and the need for strategic adjustments to mitigate negative impacts. The company's financial performance indicates a strong ability to generate cash from its core operations. A notable increase in net cash flows from operating activities was observed, rising by 24.2% to $2,197 million in 2025 compared to the previous year. This significant growth is a positive indicator of the company's operational efficiency and profitability. Furthermore, the operating cash flow for 2025 stands at $556 million, which is a clear indication that the company is generating positive operating cash flow. The absence of any mention of negative operating cash flow or a decline in cash reserves on page 130 also supports this conclusion. Overall, these metrics suggest that the company's operations are generating sufficient cash to support its growth and financial stability. The company's debt level has undergone some changes over the past year. While the senior notes decreased from $329 million to $300 million, the total debt actually increased from $8,607 million to $8,524 million. However, the commercial paper program outstanding balances saw a decrease from $797 million to $699 million. In terms of interest expenses, there has been some fluctuation. The net interest expense increased by $1 million in 2025 compared to 2024, but remained relatively stable at $430 million and $431 million respectively. However, one notable exception is the significant change in interest expenses on page 128, where a loss of -$23 million was recorded in 2025. The performance of various segments and regions within the company has been mixed over the past few years. The essential health segment has shown relative stability from 2023 to 2025, with a slight increase in segment-adjusted operating income. In contrast, the skin health and beauty segment performed poorly in 2025 compared to 2024, experiencing significant decreases in net sales and adjusted operating income. The North America region also demonstrated relatively stable performance over the same period, while the Europe, Middle East, and Africa region showed a decline in 2025 compared to 2024. The self-care segment's performance is unclear due to limited information provided, but it did experience decreases in both net sales and adjusted operating income. Overall, the company's performance has been inconsistent across different segments and regions, with some areas showing stability or growth, while others have struggled. Management is focused on long-term growth despite economic challenges, with plans to continue evaluating and adjusting operating strategies as needed. The company has implemented a multi-year restructuring initiative to mitigate the impacts of macroeconomic conditions and policy changes, which includes incurring approximately $275 million in pre-tax restructuring expenses each year for fiscal years 2024 and 2025. Financial performance was mixed across segments, with adjusted operating income decreasing overall, but increasing by 1.2% in the Essential Health segment. Management attributes this decrease to volume-related net sales decreases, unfavorable value realization, and other factors. The company's risk management strategy includes hedging against foreign exchange rate fluctuations through forward foreign exchange contracts. Management is also focused on investing in the business, with a share repurchase program authorized by the board to offset dilution from equity-based awards. Additionally, existing cash and cash generated from operations are expected to be sufficient to service current obligations for at least the next 12 months. The company is monitoring the impact of enacted legislation related to the OECD's Pillar 2 inclusive framework on their tax provision. Overall, management is committed to long-term growth and is taking steps to mitigate the impacts of economic challenges and policy changes. While financial performance was mixed, the company remains focused on investing in its business and managing risk through hedging and other strategies. The company has a history of distributing value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out a certain amount per share, with the range being between $0.205 and $0.2075. The total amount of dividends paid has also been substantial, reaching as high as $1.581 million in December 2025. In addition to dividend payments, the company has also engaged in share buybacks. In October 2023, a share repurchase program was authorized, allowing the company to purchase its own shares on the market. As a result of this program, approximately 9.2 million shares were repurchased for a total cost of $197 million. This demonstrates the company's commitment to returning value to its shareholders through various means. Concerns about inventory buildup and supply chain disruption are prevalent across various industries. Inventory buildup is a significant concern, as highlighted on page 23, where it is mentioned as a specific issue. This problem is further exacerbated by inaccurate demand forecasting, supplier discontinuation, and inflation, page 29. The potential for supply disruptions and service outages due to cybersecurity threats and interdependency on third-party partners also poses a risk, page 30. Supply chain disruption is another major concern, with multiple pages mentioning its occurrence. Pages 25, 27, 28, 41, and 42 all highlight the issue of supply chain disruption, citing various factors such as labor disruptions, global supply chain disruptions, rising geopolitical trade tensions, work stoppages, diminished protection for intellectual property, financial or operational difficulties of manufacturers and suppliers. Inflationary pressures have increased in recent years, leading to higher costs of raw materials, packaging components, and other inputs, page 76. This trend is likely to continue, further exacerbating the issues of inventory buildup and supply chain disruption. The cumulative effect of these concerns suggests that companies should be proactive in addressing them to mitigate potential risks and ensure business continuity. That concludes the financial summary for Kenvue Inc. Feel free to comment below, and I will be happy to answer them when possible.